Hello and welcome to your Recipe for Financial Success with me, Emma, and my colleagues Becky and Julie.
In each episode, we'll be bringing you a list of ingredients to help you cook up a storm and master methods to finesse your finances. We'll be helping you expand your repertoire and hopefully teach you a few new skills along the way.
So, clear the counters and get your mixing bowls ready for today's recipe. Let's get started.
Happy birthday, Becky!
Thank you very much. A whole year older.
So how old does that make you now?
28.
I think you've given away your age before on the podcast, so I don't feel that I'm giving away any trade secrets at this moment in time.
There's no gasps of shock. How old?
How young, Becky, you mean?
Wow.
I know. Tell me about it. She is very young. So what did you get? Anything nice?
Well, Emma brought in some lovely cupcakes for me,
Ooh.
made by her own fair hands.
Of course.
A nice vanilla sponge with nice pretty butter icing on the top. So
Can't have a birthday without cake, eh?
Well, no.
You are getting better these days, Emma. The patterns are getting more and more intricate. You've obviously been spending a bit of time at home on those.
Yeah, far too much time in lockdown to practice baking stuff, let's face it.
Well, when it works to my benefit, I don't mind.
Yeah, we're definitely not complaining at this side of the room. Don't you worry. Keep at it. You know, the more practice, the better. You know, if you ever need people to try your samples, hate to see them to go to waste.
Yeah, my issue is I need the gym to open and fast so I can actually get rid of some of the cake, but never mind.
Yeah, true. Exercise seems to have kind of gone by the by a little bit in lockdown, to be honest. So
Yeah, it's been a bit of a struggle, really, hasn't it?
Never mind. Anyway, in this week's episode, we're weighing up whether you should save or pay off your debts.
Okay, then. That sounds very interesting.
This is actually a topic that we've been asked for a few times by people, so hopefully they're now going to be listening in so they can have all their answers.
excellent. Okay, Emma, I'll let you start off.
So lots of people will probably think this is a really obvious one of, well, why would you save if you've got debts? Surely you should just pay off your debts.
But it's not always the case.
No. So it really depends on what your debt is, the interest rate, whether it's affordable and if you can service your debt. But before we give you any examples today, we're going to talk about kind of what we think is good debt and what's bad debt. So, Julie, do you want to tell us about what we think good debt is?
Yeah, I certainly can. So good debt would be things like, for example, your mortgage.
Mm-hmm.
If you've got a low interest rate and it's in a fixed period. So you know exactly what the rate will be for the term you fix your mortgage for. And you know exactly what your monthly payments are going to be for however many years you fixed it for, possibly 5 years, 3 years or 2 years. And also you'll be able to budget for that. So there's more certainty.
That's very good. So what's bad debt then, Becky?
Bad debt is essentially it's debt where you have a high interest rate that is often variable as well. So there's a high interest rate that, because it's variable, can potentially keep getting higher and higher. So that makes it very hard to budget for from month to month if you don't know what the interest rate is going to be doing. If you think back actually on that topic to the store card episode that we did, we looked at interest rates and how they can roll up in that episode. So there's a sneaky little plug for that episode if you didn't catch it the first time round. So that's some examples of bad debt.
Very good. So now we know what good debt and bad debt is. What's the answer? Should you save or should you clear the debts?
I guess a part of it does depend on the interest rate.
It does. So if you think about the bad debts, so your credit cards and store cards or even some loans that might be on a really high interest rate, it's definitely worth working on those and paying those down. So if you've got spare money each month, whether it be £20, £50, £100, it's a good idea to use that to pay those off rather than save, because it's basically going to help you to bring that down and have less interest accruing on there. It's also a good idea if you can, with credit cards, if you can move it onto something that's 0% or even just a lower rate than what you're on at the moment. If you can do that with any kind of those debts rather than save, it's a good idea, because you've got to think some people only pay a minimum payment on a credit card. Sometimes if you've got kind of quite a big balance on there, the interest that accrues each month can actually be more than what the minimum payment is. So your debt is just going to grow. It's never actually going to go down. So if in those kind of scenarios that you can pay off that debt as quick as you can. So any spare money you've got, if you can throw it in that direction, it's going to be a really good thing to do. So in that scenario, I'd say clear the debt, don't save.
No, that's really good, Emma. I actually have a really good example of good debt.
Mm-hmm.
Do you want me to tell you?
Yeah, I do, definitely.
Okay, so we've got a fixed rate mortgage, and our interest rate is 1.69%.
Mm-hmm.
And up until sort of the end of last year, or the year before, 2019, we were paying into. We've got an offset mortgage as well. Sorry, so we were actually paying an amount of money each month into the offset mortgage to lower our interest rate. However, when the market kind of dropped dramatically in March last year, we made the decision to actually take the money we'd been paying into the offset mortgage at regular payment and actually put it in the market instead.
Mm-hmm.
And that meant, because we've got over 5 years left on our mortgage, we felt that we would get more growth in the market for the money than we would the saving on our interest rates. So rather than paying it off the mortgage, because essentially if we pay it off early, there'll be a penalty because it's in a 5-year fixed rate. We're using that investment to actually grow rather than to lower our interest rate, which is only 1.69%.
That's really good. I'm glad you talked about that one, Julie, because I actually started having a look online earlier about what interest rates are as well on mortgages at the moment. So the lowest one I can find at the minute was with NatWest, which is 1.37%. So only a little bit lower than yours, but that's ridiculously low, don't you think?
So low.
I thought ours was low at 1.69, but to be fair, we have had it about 3 years, so that would probably explain. So yeah.
I know, it's crazy, isn't it? So I was basically trying to work out what you would need to do to basically make it better off to save than spend. So obviously your example works that perfectly.
And actually, looking at the growth of our investment over that time, it's actually made 16%.
Incredible. So that's a really good example of it. So I was having a look at bank accounts to see what the highest interest rate you can get on a deposit account is at the moment, and it's 1.5%. So it is slightly better off, but you're not really worthwhile doing it because there's such little in it at the moment. So if you're going to do it, investment definitely sounds the way, especially the times we've had at the moment. Paying in has been a really good time because the markets have been quite low. But I was having a look. So we've talked in a previous episode about 5 steps to planning your finances and Pipsy. So before you obviously get carried away and do exactly what Julie's done, make sure you've covered all those things first and gone through all those steps to make sure you've got those other areas covered. But if you get to the end and yes, you've covered everything and this money is still spare and you can afford to pay off your debts, so you can afford your regular monthly payments on your mortgage, then yeah, definitely have a look at investing. But I was then trying to think of it the other way around. So think you can afford your monthly payments on your mortgage, you're really comfortable with the term, you're happy your mortgage is going to carry on until you're 55 and you're quite comfortable with that. If you had £100 extra each month, you could pay that off your mortgage. But imagine you had £100 extra each month, and instead of paying that off your mortgage, you saved that. So over 15 years, that would equate to £18,000. That's without any growth. So Julie's just said that she got 16% on hers. Obviously, that's not going to happen all the time and not necessarily on an annual basis. But I had a look. If you, say, had an average growth of 3%, which is quite a conservative amount, I think, in an investment, after those 15 years, by paying in £100 a month, you could have £22,854. So if you were paying that towards your mortgage, it would mean that you might be able to reduce your term and you could finish paying off your mortgage at, say, 53 instead of 55, which might be important to you. But if you've already thought, well, no, I'm happy with it being 55, why not invest it? Because if you were to, say, finish paying off your mortgage 2 years early, do you think that you could save almost £23,000 in those couple of years? Okay, you wouldn't have your monthly mortgage payments to be paying by then, but do you think that money would get swallowed up on something else quite easily because you're enjoying doing other things now? You've got this spare money. Do you think you'd really just be saving it?
Yeah, I know what you mean, Emma.
So I think it's a way that you could get to the end of your mortgage term, have paid off your mortgage, and actually have a tidy little sum sat there waiting for you to do the things you enjoy by then.
I think one of the things as well about the topic that we're talking about today is you're going back to the topic previously, is the attitude to risk of the person and how you feel about that.
Mm-hmm.
Some people are like, they work all their lives and it's their goal to pay their mortgage off early. I know, look, my parents, some of those people, they wanted to pay the mortgage off early and they did. But if you can look at it as if look at it more logically, then there could be an alternative option for you. So it's always good just to look and weigh up your options and see what the best option for you is when you've looked at those.
Yeah, and I think it really closely links to attitude to risk and how it's not the same for everybody. For one person, it might be the right thing to do that, but for another, they might not feel comfortable, like you say. So all the episodes that we talk about do link together really closely, but that's why we're trying to break things down like into bite-sized pieces to make it easy for people to kind of comprehend.
And also give you a bit of food for thought.
Most definitely. And with that, we've completed today's recipe. We hope you have enjoyed following along with us today and cooking yourself one recipe closer to a financially secure future.
If you've enjoyed today's podcast, you can head over to www.recipeforfinancialsuccess.co.uk, where you can find out more information and a full list of ingredients from today's recipe. For more hints, tips and tasters, find us on Facebook at Your Recipe for Financial Success.
If you'd like to get more involved, share your own experiences and learn from a friendly community on a similar journey to you, why not join us in our new Facebook group, The Money Compass, where we will support you to navigate your way to financial success.
Thank you for listening and see you next time.